Hello, everybody, and welcome to the session on data-based investing. I am Kevin Laws and was the CEO of the AngelList holding company up until we spun out all the various businesses that make up AngelList today. And I am joined today by Collin West and Tomasz Tunguz, who I will introduce in a moment. I figure what we do at the beginning is give a bit of an overview of the data that we are seeing right now on the market. And then we can get into some questions and answers. So if you have questions, go ahead and add them, and we will get to them as we get to the question session. So I think this is not news to many of you right now that we have moved from, I'll call it the best of the boom times about a year ago to some pretty bad times today. And when I say bad times, I will define that quantitatively. Along the bottom axis, you have the percent of all the entire AngelList portfolio that has done any kind of financing event. So it's a good measure of how much activity there is. Right now, November 22, there's not that much activity compared to normal times and certainly compared to boom times. And along the left axis, you have what percentage of that activity was an up round or a positive exit or something good as opposed to a down round or a flat round or a negative exit. And the main interesting thing I will point out here, however, is that we are, at least in November of 2022, coming off of the lows and starting to move up and to the right again. We will see if that holds. The next is, this is a little bit of a surprise to me, is you're seeing the valuations adjust more quickly than we have in some of the past downturns. Valuations have tended to kind of stay higher while activity drops, and then people finally drop the valuations. The valuations are down across the board in all stages that we track anyway, up through Series B. And now moving over to some of Silicon Valley Bank's data on the report that we work on together, they track a cohort of companies and look at some key metrics there. These are the revenues by sector, and you see the revenues dropping over the last, certainly the last quarter for some of the industries, the last 2 quarters. And the other interesting data point, which is other than in consumer, you're seeing the payroll spend continuing to rise at some of the companies. I think you can see where this is going if the sources of capital are less than before, both revenues and financing, and the uses of capital are rising. That's unsustainable. So that's why you're starting to see some of the news about layoffs and et cetera, as people are right sizing for this environment. So next, I will turn it over to Collin West, who's going to talk about some of the next stages, since primarily what we're dealing with are the early stages with pre-seed, seed, and A. Collin West has been in data-based investing for a number of years, over a decade. He was part of the founding fund of Correlation Ventures. He founded the Kaufman Fellows VC Research Center, and he's now the founder and managing partner at Ensemble VC. And all of that's about data-based investing. I looked at the team page, and they have more data scientists and engineers on their team page than investing professionals. So with that, let me turn it over to Collin.
Awesome. Thank you, Kevin. Really appreciate you guys having us and everyone on the AngelList team. I mean, we're huge fans of the AngelList platform, actually customers across many of your products, and just grateful to be presenting to everyone here today. So quick background on Ensemble. As Kevin mentioned, I'm a founder and managing director of Ensemble VC. We focus on Series A and B investing, mostly in the US. And why we're here today is we spend a lot of time leveraging data to help us identify startups with top teams, find the companies to pursue, but then also help those teams build out their teams after we invest. So we track a lot of talent data. this has worked well for us. So historically, between my partners and myself, about half of our companies have become unicorns within 3 years of investment. So that's us. Now for the presentation, I'd say okay, we've got the slide up, perfect. So I'd say the goal for today in this presentation is, one, just quickly give a perspective on the health of the startup market and thoughts there. And then two, given the startup market, try and paint a picture of the opportunity startups have in this space. So as for the market, as we all know, and based off of the AngelList data Kevin just shared, there's been a correction, obviously, in the public markets that's trickled down into the private markets and the overall startup ecosystem. So while it's difficult to predict how the environment will continue to play out, we do think it's helpful to introduce kind of a framework that really helps us visualize what may be happening in the market, and then also give some historical context around what we're seeing. So this recent chart from SVB we thought was really great. So shout out to our friends at SVB. It tracks and measures kind of two main things. One, in the white line, you see the pendulum between founder and investor balance of power. So this is based off of deal terms and structure. Who's getting the better terms? Who's getting the better structure? And you see that swings back and forth. Another pendulum is also startup valuations in purple. So what you'll notice over time is during more, defined as founder-friendly environments, there's a significant rise in valuations, which makes sense, right? This tracks with what we saw in 2021. As VC activity surged, the competition to get in on the best deals put many founders squarely in the driver's seat to command these outsized valuations. As a result, investors were also writing really big checks in order to get their ownership. And many investors were forced to make very quick decisions, and many times without much due diligence. So we're obviously seeing a lot of this unwinding a little bit right now in these larger and larger, very quick rounds that were happening in 2021. But as we come to today in 2022, right, the mood in the public market shifted. VC startup environment has changed dramatically. And what we see is this balance of power has really shifted into this much more healthy band, kind of more in the middle. You see this light purple band in that chart, where it's really an equilibrium for both founders and investors. So we think that this will hopefully result in the coming quarters in an increase in transactions and more investing activity. So we'll see what happens. Obviously, we know founders' expectations for valuations have gone down. There's a renewed focus on fundamentals, on building a durable company, obviously looking at positive unit economics, capital efficiency. And it's not just a race to get to that next financing round. So now I think additionally on this, it's important to place some historical context around this environment. And believe me, I'll get to the good news. It's not a perfect prediction, right? History never repeats itself, but it does often rhyme. And so what's interesting is that these post-correction moments, as we all know, has also coincided with strong and resilient teams kind of coming together to form some generational companies, right? So at the bottom of this slide, you'll see post-dot-com bubble, companies like Facebook and Tesla were founded. Post-greater financial crisis of 2018 or 2008, companies like our prior portfolio company, Zoom Video, was founded. Airbnb, Uber, Slack. So we ask ourselves, in this environment, how do you, as investors, find the next Zoom, but also as founders in this market, how do you build the next Zoom? Where we're in a market where momentum investing really isn't working. And many of these companies' valuation expectations may be different than before. And so what we believe from a first principles point of view, and why we built our firm the way we have, is it's all about great teams that can execute on a mission, right? Because if you can create value for your customers, that value turns into growth, and sometimes very fast growth. Now, of course, to be frank, that's not that groundbreaking of a point of view, right? A great team is obviously much more likely to win, but the hard part to date for founders has been actually being able to recruit and build those great teams. So now on this next slide, here's the good news for everyone. So over the last few years, finding that great talent has been extremely difficult. So we dove it into our talent data set. And what we found was pretty interesting. Amid all of this market uncertainty, you would think post correction, so the first 6 months of 2022, right after the correction, you would think that a lot of talent would have a flight to safety. So if they're switching jobs, they're going to go to maybe a later stage, stable tech company. They're going to go to, a different industry that's much more stable, something like that. And what we actually found was the opposite was happening. During all of this uncertainty, the talent in startups didn't get nearly as fearful as we expected. In fact, they got more risk loving. So more than 80% of people moving from startup to startup were moving to a company at the similar stage or an earlier stage than where they were before. Less than 20% were moving later stage. So we think this is a very interesting sign for startups because it's been so hard to recruit talent, right? And especially at the earliest stages. And so what we think is startups now have more talent than, in recent years they've had in, maybe over a decade to choose from. And it should be a little less competitive hiring market. So especially as we've seen later stage, large tech companies famous for kind of giving folks these golden handcuffs, slow hiring. So there's a big talent pool. It's a great time to be adding people to your team or building a team. So that's the end of my presentation, Kevin.
Great. And next we have Tomasz Tunguz, who has been, I'll get to why in a minute, winning with data for over 17 years. He's been oversaw Google's AdSense for social networks, and then has been a partner at Redpoint Ventures, where he uses his data skills to invest. And along the way, he literally wrote the book called Winning with Data, which is still available on Amazon. So I'll turn it over to Tomasz to talk about what he's seeing in the later stage markets.
Thanks, Kevin. Great to be here, everybody. Nice to meet you. My name is Tomasz. Been a venture capitalist for 14 years, wrote a blog, lots of data at tomtunguz.com. And I'm going to talk a little bit about what's going on in the public markets and what the ramifications are for the early stage markets. I'll cover 4 points. The first, at a high level, is that we are in a radically different valuation environment than we once were. And that valuation environment, instead of prioritizing revenue growth, is now prioritizing efficiency. And that's actually changing the way that companies are going to market. The second is that the sales environment is significantly slower. So something like 70% of our portfolio companies are actually seeing materially slower sales cycles. And that's changing the way that companies are operating. And then the last data point that I'll touch on is there's been this post-COVID question about whether or not the Bay Area still remains an important investment market, and clarify that. So if we can pop up the slides, walk through the data. Okay, great. So one of the analyses I like to do from time to time is I look at the valuations of software companies and or a bunch of the different metrics. And one of the key metrics is the sales efficiency metric. The sales efficiency metrics asks or answers the question, how many dollars do I need to invest in order to buy how many sales and marketing dollars do I need to invest in order to buy $1 of revenue? And what you can see over the last 6 or 7 years is you've seen a secular decrease in sales efficiency, which means each company has to spend more to buy a customer. And so software companies are actually becoming less efficient in order to grow. That's probably a byproduct of the fact that the U.S. venture capital ecosystem has grown about 40 times in the last 10 years. And so there's just more competition. Emails become saturated, Google's become saturated. And with more and more people competing in those categories and sending messages, it becomes harder and harder to actually build a business or more expensive to do it. And so if we go to the next slide, what we've seen in the public markets, and that's definitely manifested in the private markets, is that the importance of product-led growth is clear. Can we advance the slides, just one? And so a product-led growth company, and the reason why, a product-led growth company, what they do is they try to educate a user through the life cycle of that user's journey using the product rather than sales and marketing. Atlassian was famous for doing this. They spent almost 35 to 38% of their revenue on R&D, spending less than 15% on sales and marketing, which is highly unusual. Obviously, a hugely successful business. And if you look at the public markets, you can clearly see that what's going on with the product-led growth companies, they're actually starting to spend even more on sales and marketing, on research and development at the expense of sales and marketing in order to grow super efficiently. And that dynamic happens in the public markets just as much as the private markets. And the reason for that is, if we go to the next slide, you can see that the publicly traded software multiples, which is in the purple line, they grew from about 5x is the 20-year median, so it's been bobbling between 5 to 5.5, and then as a result of all the quantitative easings and the post-COVID surge, you saw it get to 15, and some of the most valuable companies were trading even like 50 or 60 times forward, which had never been seen. Now we've seen a 50 to 70% collapse in those prices. And that's really because it's been driven by what's going on with the Fed and the Treasury. So the higher the Fed interest rate, the lower the valuation, the correlation coefficient of negative 0.48. And the result of that is that all these companies, the highest correlate to public market valuation is ultimately efficiency, is sales efficiency. And so that's why you're seeing a ton of companies go to product-led growth, because one, it's more expensive to acquire customers using sales and marketing, as we saw that monotonically increasing curve. And then the second is, the more efficient you can be as a business, the more valuable you will become, because your multiple will be higher. Yeah. Okay, next slide. And so, I ran a linear regression. I was trying to figure out, okay, like if the 20-year median for forward multiples for software companies is around 5 to 5.5 times, and we build a linear regression in order to predict what given the ultimate 10-year rate, what it's going to be, what would that imply for the forward revenue multiple for software companies? And I've been watching what's going on in the federal market and in the Fed funds market. And if the Fed funds rate or the 10-year get to about 5% rate, you're talking about seeing another 60% come off the multiple. And the valuations are actually hugely sensitive to small. You can see even a 25 basis point delta between the 10-year rate actually almost adds like 1x to the forward multiple, which is why anytime there's news about the Fed being more dovish or inflation coming down, the software market surges like it did 2 or 3 days ago. So this is sort of the range of, at least that a basic linear model would predict, the range of forward multiples. And just to kind of put it into perspective, the lowest we've ever hit, as far as I've tracked, is about 3.3, which is about a 40% reduction from where we are now. We're at about like 5-ish. And we saw that 3.3 multiple there in February of 2016, when the whole market actually tanked 57% in a single day based on Tableau earnings. So it's not unprecedented to actually see a pretty material degradation here. But I think we'll see a lot of volatility, and that volatility is manifesting itself into changes in pricing, just the way that Kevin showed at the beginning. The third thing that we've seen quite a bit in portfolio companies, as I mentioned before, is about 70% of them are seeing materially longer sales cycles. Talking to buyers, anecdotally, a lot of them are adding 3 to 4 more calls or meetings in order to actually buy something. It's not that the budgets are necessarily being constrained, but the processes are longer. And so the impact to having longer processes actually manifests itself in much more bookings volatility, which we're seeing in portfolio companies. And just to kind of illustrate the point, imagine you're a hypothetical software company. You've got, 50-day sales cycles here. And before COVID, you've got this hypothetical quarter where you've got 2 customers closing in the 30-day to 60-day period. And you've got 2 customers closing after 60 days. And if each of these customers is worth about $100K, you're looking at about 100K bookings, between 30 to 60 days, and you're looking at 300K in bookings in the next period, which is a really nice ramp. If you go to the next slide shows exactly the same. It shows exactly the same chart. Actually, they're flipped. Oh, that's right. Okay, so we're going to go backwards. So what this chart shows, let's reset. So go to the second slide, please. Yeah, that's the one. So we'll start this. Suppose you have a hypothetical software company. You've got 4 different customer prospects. 2 of them are going to close in this quarter, which is that dotted line, and 2 of them are going to close in the next quarter. Each of them are worth about $100,000, which means you're going to close 200,000 in this quarter and 200,000 in the next quarter. Now, let's say you double the sales cycle. So let's go to there you go. So now what's happened is the sales cycles have doubled. I'm not going to close anything in this period. So my bookings goes from 200K to 0. In the next quarter, my bookings goes from 200K to only 100K. And then I'm looking at, a significant quarter, a significant bookings period, 3 out. And so now I've got a lot more volatility in my bookings. And this is a pattern that we're seeing across most of our portfolio companies. And so the advice that we're giving to them is that they need to have significantly larger pipelines per sales executive in order to have any kind of consistency given the market dynamics. Awesome. And then the last question, this has kind of popped up. It's been kind of the zeitgeist in the press, which is how important is the Bay Area in terms of venture dollars? And the overarching narrative has been like, look, the reality is like the Bay Area share of venture dollars is actually down 5%. There was another headline that said it's actually less than 20% of dollars. But if we go to the next slide, just to kind of put it into perspective, as I said before, the U.S. venture capital asset class has grown about 40x since 2010. We're going from $8 billion invested a year to $320 billion last year. And what this chart is showing is San Francisco's share of those dollars in purple, and then the lavender is the U.S. And just to kind of put a fine point on it, in 2021, San Francisco-based startups raised $124 billion. That was the same amount as all the entire United States raised in 2019, 2 years before. So this idea that dollars are going out of San Francisco into other geographies isn't true. The whole asset class is growing fast enough so that the growth rates everywhere are pretty significant. And Bay Area startups still remain pretty important at something like 50% of all venture dollars raised.
Thank you. So let's move to some questions here, and I've got some I'll ask, and then we'll open it up more broadly. So Tomasz, let me start with you because you've talked about how far the software multiples are falling, and thus how far some of the valuations are falling at the public markets. That fall has been significantly more dramatic than what we've seen in a valuation fall in the early stage markets. Are you predicting that there will be a higher valuation fall in early stage markets, or are they not quite that correlated? Why aren't they trickling down? And
great question.
What speed will they?
Yeah, so there's about $240 billion worth of venture capital that's been raised in the last year. That's kind of what we call the overhang that needs to be deployed in the next 3 years. 80% of those dollars are from non-traditional venture capitalists, so hedge funds, crossovers, private equity. And that, I think, is going to keep the valuations, particularly at the Series A and the Series B, pretty high because there's a significant amount of competition in those stages. And so it's going to depress returns at the Series A and the Series B.
Right. So throughout the downturn, or do you think that it will eventually trickle down?
It'll only trickle down at the point where the amount of dry powder actually lessens, right? I mean, it's like we're like a 10 to a 15-year high in terms of dry powder. There are individuals who need to put that capital to work, people who want to get promoted. And so, what I've noticed is, particularly the data and the machine learning ecosystems, you're actually seeing valuations, you're actually seeing Series A and Series B companies raising rounds that they would have raised like a year ago before the correction. And that's driven all by kind of crossovers and late stage investors coming down and setting really high multiples, like 100x, 125x ARR, stuff like that.
Got it. Collin, so let me go to you next. You mentioned that people are going to earlier stage startups from their mid-stage startups. That's kind of the shift you're seeing. Why? I mean, when we saw our data in COVID, when we were looking at what is now Well-Found's data on hiring, right during COVID, we suddenly saw a shift towards safety, exactly as you said has happened before. Why the shift towards earlier stage and riskier ventures right now? Or is that related to what Tomasz was just saying?
Yeah, it's a great question. I think one big lever is certainly that there's just less jobs available at big growth stage companies right now. A lot of those are kind of culling their teams, making their teams smaller. And, part of my presentation, I think a big piece of that is just to sum up is that I do think that one, there is an influx of top talent. The startup ecosystem is just becoming healthier. So influx of great talent early stage. And the second piece is there's a more stable equilibrium between investors and startups. Hopefully that'll continue to get even more stable. And so now we just think it's the best time and really over a decade to be building an early stage team, right? I would say there was a time when we probably all remember this 12, 18 months ago, where any company you looked at investing in had 5 super well funded competitors. And so hopefully now there's going to be fewer competitors for these companies. And this tech talent is just going earlier.
Got it. So kind of follow up, you've mentioned it's a really good time to be starting a company. Presumably, if you have money and you're building, getting good talent, you can do. What about investing in a company? You're doing data-based investing in talent-rich companies. So what's your perspective on investing right now?
Oh yeah, well, we think it's a great opportunity to invest right now. We're actually very active. We did slow for a little bit just to kind of see everything settle, but we are finding that there's some teams really aggregating some fantastic folks right now. And I think, whenever you think about the end goal of a startups is you want a great team that can execute on their mission and then grow quickly, right? That is the goal. Great team that can execute its mission and grow quickly. Right. And what we've seen is a lot of the goal was, how do I get to that next round? So right now, what we love is people refocusing on building a durable business, focusing on positive unit economics, creating value, which sometimes takes a little while to build and create value for customers, and that results in growth. So I love the idea that folks are not managing their companies for the next round and hopefully managing their companies for the real goal of creating value for customers.
Yeah. So one more follow-up. You're actually, for both of you, this one was posted in the comments, so it's a good follow-up for now, is how does the data influence your timing and investing strategy? Do you adjust your bite sizes or flow of investing dollars based on the data you're seeing now, or do you just keep constant? Why don't we start with Tomasz and then go to you, Collin?
Yeah, I mean, I think you can't time the market. That's because average software company takes about 7 years to sell and 12 years to go public. So you're probably going to see at least 1 or 2 cycles within the course of an investment. What I think the thing that's the most salient change in the last year is you've really got to look at entry prices in a way that you haven't needed to in the last 12 years. Because if you were, I remember like 4 or 5 years ago, I was talking to a friend, and he was working at one of the great venture capital firms, and their philosophy was anything under 100 pre doesn't matter. The difference investing in 20 or 40 or 80 or 100 at the Series A doesn't matter. And I think, here in this ecosystem, it matters quite a lot, because you can be a publicly traded company generating 200 million a year in revenue and it's worth 3 billion. And so the difference between investing at like 50 posts versus 100 posts is pretty significant. And your comp set is completely different. So I think that's the thing that sort of changed in my mind the most in the last year. And so that's just as much to do with entry prices as it is ownership. You've really got to take a look at your fund model and reevaluate how it is that you're going to generate a high multiple fund given the new valuation environment.
Got it. And how about you, Collin? It sounds like same pace, but more valuation sensitive from Tomasz.
Yeah, I would say, wholeheartedly agree with Tomasz. It's not about timing market, it's about time in market. The old adage is true. I'd say one thing that we've been thinking a lot about that I think a lot of venture firms got wrong over the last couple of years is vintage diversification. So there were a lot of folks who found that they could deploy money really quickly. And they started moving their vintages to deploying their entire fund in 12 months, 18 months. That doesn't do any favors for your LPs when some shock happens in the market. And so really what you want is at least a couple, if not 2.5, 3 years of vintage diversification so that you go across time periods. And so I'm hopeful that many of our investor friends that have slowed their pace are actually just moving to more vintage diversification with their funds.
Makes sense. Okay, so you've mentioned, Tomasz, this was in your presentation, that San Francisco is still the main hub for the dollars, but are you seeing, are those dollars going to companies that are then doing remote work? That is, is the work happening in San Francisco or just the fundraising?
Yeah, I wish I had an answer to that question. So that data is based on the headquarters of the company that raised the capital.
Got it. Collin, you may have this then. Yeah. You know where people are.
Yeah, well, I don't have the exact answer for you, but I do know just generally trends is one of the most interesting thing that's happened since the pandemic is, as we all know, I'd say subjectively, but I can tell you also objectively, that people are able to work from lots of different places now. So where your company is headquartered does not really mean that's where the team is or where even the majority of the team is. And it's been really interesting to try and track companies this way because just like Tomasz mentioned, San Francisco is still the heart of really it all, where a lot of great stuff is happening, but great companies are being founded everywhere right now. And it's hard to find them if you're locked in a specific geography. So the cool thing, sorry, that's my phone. So the cool thing about right now investing is being able to open up geographies and use hopefully Zoom video when you do so.
There you go. Tomasz, you talked about the fact that the valuations weren't trickling back to the early stage because of the overhang of capital. How about the late stage companies? Because they're more reliant on the IPO window, right?
Yeah, totally. So the dynamic in the late stage market is different. Like at least anecdotally, the early stage market is still pretty active. And there's like a pinch or a bunching, like you can imagine, like train cars in the mid-market where you've got a lot of companies who in the last couple of years have raised literally hundreds of millions of dollars. And so they've got 3 to 7 years of runway. And their strategy is to continue to grow, but try to skip the dip, try to continue to grow throughout the market, never be repriced, and then raise or go public at that point in their life cycle. For the rest of the late stage companies, there's a material repricing event that's happening. So I surveyed 500 founders earlier this year. I asked them if they were raising this year, what they thought, how much they expected their valuations to come down given what was going on in the market. And they said on average, they expected a 10 to a 15% decrease in their pre-money valuations given the macro. And then, you can survey private market investors and their expectations match what's going on in the public markets, which are 55 to 70% reduction. And so there's this gap between the bid-ask spread effectively between the buy and the sell side. And the reason the market isn't clearing is that gap really hasn't narrowed yet because a lot of companies aren't yet forced to go to market. And so the deal volumes are you usually got like a handful of incredible companies continuing to raise at very similar prices just because they're performing exceptionally well. And then you've got like a lack of data everywhere else because no one's actually coming to market to reprice unless they absolutely need to. And so they're going to meet at some point in the middle. And my guess is it's probably a 30 to a 40% reduction in valuation, if I had to hazard a guess.
That's interesting. Yeah, our data shows something similar. If that first chart I showed, typically as things start to slow, you see the valuations holding, but activity dropping because nobody wants to do business at those valuations. Then the valuations drop, then the activity picks up. So it kind of goes in a circle on that chart. I was a little surprised how quickly I mentioned at the beginning that the valuations are dropping sooner than we normally see in that chart. So I'm curious whether it's just that the news was so bad and dramatic that that's happening, or that the market has become somewhat more efficient. If either of you have observations on that.
Yeah, I'll jump in. Look, there have been five in the last 12 years. There have been five major public company dips for multiple dips of 40% or less or more. Sorry. So five major SaaS corrections. And in each of those cases, there was a pretty quick, like you could buy the dip. It would recover quite quickly. And during all of those scenarios, you had significant quantitative easing. You had the Fed actually printing more money. This is the first time we've got a dip in the public market and there's quantitative tightening and an increase in interest rates. And as long as I've been in venture capital, very few of us have been armchair macro economists, and it seems like we're also suddenly thrust into that role where we've got to take a look at what's happening with the Fed and figuring out what to do. So I think that's the big difference this time.
Got it. So let me move from, we've talked a lot about the macro level, that is what's going on in the bigger environment affecting the timing and et cetera, and valuations of investments. Let me move to the micro level of the data-driven investing. And I'll start with you, Collin, because I know at least partly where the answer lies given what your fund does. What is it when you look at the data that you can use out of data to identify a good company?
Yeah, good question. I mean, I think for us, it's not really about finding some magic metric. I think the main issue in startups is last year alone, 50,000 financings were announced in the US. And we just don't think any credible investor can say, hey, I met them all and these are the best ones. Not only that, but if you're meeting them, you're only meeting the founders. In general, you're not really meeting the whole team. So what we use software to do is kind of look for what you would look for in a great team, but just do it more scalably so that we can sort the team by team quality. And now that does not mean that those companies will be successful, of course, but they're just more likely to be successful. I mean, we've all worked on good teams and bad teams. Obviously, the better teams are a little more likely to be successful, right? And so as a firm, that allows us to narrow our focus, to spend our time with a much shorter list of companies and spend more time with them. That enables us to build a real relationship, meet them before their fundraising, help get to conviction quickly, be the first to commit, and help put rounds together. And then, of course, after we invest, a lot of the research that we do then helps make our teams, the teams of the portfolio companies we invest in, get better. So we leverage a lot of this data to help us identify where we can improve our team, who out in the ecosystem would be a good match for this particular company. It ends up being a really strong value add and a great way to help your teams and show value on the cap table.
Yeah, it's interesting because we have had a similar observation at AngelList. We're sitting on this giant pile of data of early stage companies, and we're looking at what can the data tell us about which are the interesting companies. And the data can tell a lot, but unlike most people assume, it's not the characteristics of the company. It's not that this founder has that many years of this or things that you can pull from data. The data that becomes most interesting is where you can analyze the social network and say, here's a good read on what credible people think of the company. And you're doing the same from an employee angle. Here's a good read on what people think of that company, rather than here's some number that we can use to identify early stage. So Tomasz, let me turn it around to you, because you've invested across stages and are in some later stage where there is more data and maybe it can tell you something. What does the data tell you about where you should invest?
Yeah, I think the data that's the metrics that are the most important in sort of the mid stage. The first is obviously ARR growth. The second metric is net dollar retention. That's really important. Net dollar retention is how much do customers expand on average in dollar terms on an annual basis. And that tells you, it's sort of a proxy for the product market fit. How well is the product meeting the needs of the customer? And the one metric was sort of less important, but has become increasingly important in this environment, this goes back to the slides that I showed about the pipeline shocks, is the pipeline to quota ratio. And one thing that's meaningfully changed is I would rather see a smaller number of account executives in a mid-stage company consistently hitting their quota rather than a larger number with, say, a lower quota attainment. So I'd rather see 3 account executives having more pipeline and hitting 70 to 80% of their quota consistently, rather than having 5 or 6 account executives in a business seeing 50 to 60%. And this goes back to the efficiency point. It goes back to the volatility in bookings. So that's been a pretty important metric. The other sort of metric that's come to the fore that's been also equally important is sales cycles. I think it's very difficult to finance enterprise sales companies who have sales cycles of 120 to 270 days, because again, like the volatility on those deals and the additional procurement conversations that you need to have are tough. And so that's why companies who've got 30 to 60 day sales cycles in the mid-market are really appealing. And then also those that are product led. So that leads me to the last metric, which is what percentage of leads are coming inbound, what percentage of customers are knocking on your door, your website, and saying, I really want to learn more, please tell me about it, or I'd like to buy. That's become super important as well.
Got it. So that's focused primarily on SaaS companies. Is that your main focus, or are there some of those that even go beyond software?
Yeah, the other metric that's a universal metric is this idea of payback period, which is how, if I spend a certain amount of sales and marketing to acquire a customer, how many months of that customer spend do I need to collect in order to recoup my sales and marketing investment? And that spans consumer to enterprise. The top decile consumer companies are operating with a 3, maybe 4 month payback period. You might see on the outer end of that spectrum, and I'm thinking here like either marketplaces or consumer subscription companies, you might see like 6 to 9 months is sort of the upper end. And anything beyond 9 months is difficult to finance, particularly in this environment. For software companies, anything from about 12 to 18 months is top quartile. If you've got a larger contract size, then 18 months to 24 to 26 months is also top half. And so that's a metric where I think in this environment, like if you see a consumer company with a 12-month payback or a 15-month payback, the conclusion is it likely doesn't have product market fit, and that the amount of cash that the company is going to need to grow is too great. The capital markets won't provide it. That's changed quite a bit.
Yep. So another interesting thing that we have seen at AngelList, we actually just recently did an analysis that's on our blog. It was a surprise to us even that the bridge rounds, the notes for the bridge rounds, turned out to actually be higher return than the rounds themselves. And this is over the last, clearly AngelList data is since 2010, so we haven't been through a significant downturn in that time frame. I am certain, given the information you guys have presented, that we're going to see a lot more of those as people have to stretch their rounds and cover that cash gap. Do you expect those bridge rounds should be evaluated as seriously by investors as the full equity rounds, or do you think that may change because of the environment that we're in?
Yeah, I think it's a pretty interesting time to look at extending the last round, right? So say you raised money 6 to 9 months ago at a very high multiple, but the company's grown a lot and it's shown that it's matured. And so while multiple compression has happened, maybe it's grown into that valuation and you have more proof points. I think there's a lot of companies willing to take more capital right now. It's always a fine balance between the companies that really need the capital, maybe don't have enough capital then to get to that next round. And so a lot of investors, it's a little bit of a mismatch. A lot of investors want to invest in, they want to extend the last round of very well capitalized companies in general that have grown. And so if you can find that match where it's a company that isn't at risk of running out of cash, 6 months after you invest, but also has some great proof points, that may be a great way to build your portfolio. I actually think it's quite an interesting opportunity. You just got to be really very careful with adverse selection on what's available in that space.
And so if you're a company and have the cash right now, you're saying maybe now would be the right time to raise a bridge round rather than when you're running out and need it.
Yeah, well, maybe it gets you to where you can have an up round. I mean, everyone's trying to avoid down rounds or flat rounds. A bridge kind of looks like just an extension to the last round. Or, you can just extend it, and it looks like, oh, they just have more money than they had before. And maybe that gets them to where they don't have to do that fabled down round that can really hurt culture and team and momentum, and people that are counting the value of their stock options and kind of feeling like maybe they're not worth as much. It's an interesting way to kind of game it, I think. Just got to be careful on both sides.
Interesting. Tomasz, do you have you're dealing with a different set of companies. I'm interested in your take on the same question.
Yeah, I agree with Collin. I think he's exactly right, especially on the sort of the optics of taking a flat round. I think that there's a dynamic at play. So when I started in venture in 2008, an inside round or a bridge was a sign of a weak company. The inside round was the round of last resort. Like you went out to market, you tried to raise for a number of months, and you couldn't do it. And so then people passed the hat around the boardroom in order to keep the company going. As the venture capital ecosystem exploded and single stage firms became multi-stage funds, the inside round actually became a huge sign of strength. If Collin's on the board of Zoom, he's got a relationship asymmetry with Eric, and he's got information asymmetry because he's on the board and he sees it. And so what he wants to do is he wants to buy up in Zoom before the IPO, before the incredible IPO. And so he says, Eric, like, look, I'll make this really easy for you. I'll just buy some more and we'll do it at a market rate. And because we know what the multiples are, we can get a sense of what's fair. And I think that dynamic sort of persisted maybe through this year, but next year it will change. And all of a sudden, a lot of these inside rounds, or more of them, are going to become what they were, say, 12 or 15 years ago.
Okay, that's interesting and not necessarily what I was expecting. So a question coming from one of the viewers right now. So Tomasz, actually, let me tie it to one of your slides. Your slide showing that as sales efficiency was decreasing, people were increasing their spend on R&D and innovation. What does the data suggest about the R&D spend and how it's coming over to innovation? You know, this is machine learning, robotics, et cetera. Is that actually starting to increase the pace of innovation, and does that show up in the statistics, the productivity statistics or otherwise?
Yeah, I wish I could say it is. I think those are all really long-term projects. Like machine learning projects tend to be 12 to 18 to 24 months to see a return. So it's not yet showing up in the data. There was sort of a surge during COVID. I actually smoothed that curve, but if you don't smooth it, you actually see in the back half of COVID, the top quartile companies actually saw a material increase in sales efficiency. And so maybe you could kind of draw a conclusion that superior leads, sorry, let me take a step back. So in COVID, the sales efficiency first plummeted and then actually hit decade highs. And my hypothesis there was, okay, first people panicked. We all panicked. We all sheltered in place. We didn't know how to sell. We didn't know how to market. And we figured out how to market and sell in that new ecosystem. And then people started to buy, and then hiring also slowed, and that juiced the sales efficiency. And so maybe there's something to do there with like lead scoring and lead prioritization and being able to sell remotely. But it's hard to sort of draw a blanket statement and say that machine learning broadly is sort of influencing sales efficiency or R&D spend, or that's sort of improving the net income margins of any of these businesses yet.
And how about kind of going to the broader question of society, the increase in R&D spending actually, like we've had a secular decline in our rate of productivity increase. Are we seeing any evidence that this increased spend is changing that?
I can offer an anecdote. Yeah, I mean, like I don't know if you guys have used Copilot, which is the GitHub coding thing, but preparing for this presentation, a bunch of the charts that I made, I literally told the computer what to plot, and then it spat it out. And there was a CEO who tweeted last week that 40% of his startup's code is actually produced by a machine learning model. And like that, are you seeing that in GDP numbers? Are you seeing that in reduction of employee headcount costs and all that stuff? Not yet, but in the next 2 or 3 years, I'm sure we're going to see a pretty significant impact from it, because humans now can operate at a higher level of abstraction than they were, say, 5 years ago because of it.
Got it. Good. So let me just open it up for some closing thoughts, and then we'll end here. Why don't we start with you, Collin? Do you have any closing thoughts on the state of data and whether we expect to see more of it in venture investing or less of it, or how do you think of data being used to make these investment decisions?
Yeah, that's a good question. I think data as it impacts the way we make investment decisions should only increase. I think it's been, so now so Correlation Ventures was kind of the first pioneering major data-driven venture fund, which I was on the team of there. And that was, only 11 years ago. And at the time, a lot of the traditional funds were very reticent to using data because it makes a lot of sense, right? They had been successful not using data. A lot of their pitch to their LPs is, I'm special, I have the magic in picking. And if I now were to go invest in a lot of data, there would be a little bit of friction between my pitch to LPs and then the way I'm investing. And so what we've seen is a lot of the traditional firms that have been successful will, hopefully continue in their own right to go on and continue to be successful. But over the last decade, brand new firms have come a lot of times being built by folks that grew up in a generation where you kind of expect to have some data to make a decision. And a lot of those firms, I think there's a huge wave of emerging managers like ourselves that have really put this at not just the cornerstone of the way we make decisions, but also the cornerstone of our LP pitch, which enables us to go invest in these things. And so the good thing is I think early results, but certainly for our firm, is it's working quite well. And so hopefully that means that we get to keep doing it and get to keep investing in this. And the end goal is, I don't think the goal here is to use more data in your investment decision. Actually, the goal is, how do you identify great teams and make sure you're more efficient with your capital and go back those teams and make sure that they grow, because that innovation changes all of our lives, obviously. And so, I think data is a great path to helping us do that. It's made us do it much more efficiently. And I'm a big cheerleader for it. I hope more firms continue to do so, because I think it's a much more objective way of picking teams than, kind of the traditional, much more subjective way.
Interesting. So data as a productivity enhancer at the upper funnel so that you can focus more on what you need to focus on. How about you, Tomasz?
Yeah, I think I'll make 2 points. The first is just like putting this into historical context. And then the second is really around using data in order to concentrate. And so on the first one, I mean, you think about if you've read like Reminiscences of a Stock Operator, the stock market in the 1920s, people really didn't do a whole lot of systematic analysis of publicly traded companies. And then Benjamin Graham wrote The Intelligent Investor and kind of spawned a new way of looking at companies based on multiples and price to book ratio and all that kind of stuff. And that really was formalized or reached the epitome of its practice with like high frequency trading and the quantitative hedge funds of the 70s, 80s, and 90s. And now we're in a place where 60 to 70% of the volumes on public exchanges on any given day are driven by computers, so it's purely quantitative. And I think you're not going to see that extent of automation within the early stage markets, but you are seeing a lot more quantitative analysis of these businesses. Like in 2008, if we were looking at a software company, nobody talked about the ARR multiple or comped it to other businesses. And that language from the public market started to seep into the private markets. And if you look at like what's going on in Web3 or in crypto, those companies go public really quickly, and we're starting to talk about price to sales multiples and comparing them to their Web2 counterparts. And so you can say OpenSea and eBay actually traded the same multiple. And so I think that's sort of a one-way arrow where we're going to continue to use data in order to evaluate, benchmark, and compare businesses. The other thing that I think has really come and will stay is, again, going back to this idea that we've got multi-stage funds, or investors are looking to kind of concentrate. Venture capital is governed by a power law, and so you want to have as many of your dollars put into the highest performing companies as possible in order to maximize the multiple of your fund. Well, in order to do that, you really want to understand which of the companies in your portfolio are operating at much better pace or are operating within the top decile of the operating metrics, so that if you do have reserves or ability to follow on or concentrate, you can move those dollars there. And I think that's a new discipline that will persist for an awfully long time.
Yeah, Naval talked about that with the as the industry scales, it is easy to pick good investments among your friends who you know well. It becomes hard when you're starting to deal with companies that are outside that direct group. So it's becomes necessary to find some mechanism to know where to focus and get to know well. So with that, thank you very much, Collin, and thank you very much, Tomasz. This has been a great conversation. And everybody here at AngelList Confidential, I hope you enjoyed it and enjoy the rest of the conference.
Thank you, Kevin. Thank you, Tomasz.
Thank you, Collin. This was great.
Oh, by the way, before we exit, if you guys are not subscribed to Tomasz's newsletter, a lot of this is in it, and it is so good. We love it. He's one of the best data thinkers out there. Please subscribe. You'll thank me later.
Thank you so much. That's very kind of you, Collin.
Awesome. Thanks, everybody.